Most investors believe the silver market is simple. You buy silver, someone sells silver, and the exchange settles the trade. But there's a question almost nobody asks. What happens if the exchange suddenly doesn't have enough silver to deliver? That exchange is COMEX, the largest futures market for precious metals in the world. Every day, billions of dollars in silver contracts trade there. Yet most of those contracts never result in actual metal delivery. They are rolled forward, closed out, replaced with new positions. That's how futures markets normally operate. Paper contracts move far faster than physical metal ever could. But hidden inside that system is an assumption. The assumption that physical silver will always be available if someone asks for it. Most of the time, that assumption holds, because only a small percentage of traders request delivery. Instead, they settle financially. Profit or loss is calculated and the trade disappears. But imagine a different scenario. Imagine more traders suddenly demanding the actual metal, not cash settlement, not contract rollover, real silver bars leaving the vault. Now suddenly the system behaves differently, because futures markets rely heavily on confidence. Confidence that contracts can be honored. Confidence that supply exists behind the paper structure. If confidence weakens, behavior changes quickly. Traders who normally roll contracts begin asking questions. Questions like how much silver is actually sitting in COMEX vaults, and how much of it is truly available for delivery. Because there's an important distinction. Not all silver in a vault is available to the market. Some metal is registered for delivery, some is simply stored there but owned privately. Only the registered portion can be used to settle contracts, and that number can be much smaller than people expect. Now imagine something happens in the market. Maybe geopolitical tension rises. Maybe industrial demand spikes. Maybe investors rush into safe haven assets. Suddenly, more people want physical silver instead of paper exposure. The pressure shifts toward delivery. At first, the system absorbs it. A few bars move, some contracts settle, nothing dramatic happens. But then the requests continue, and the inventory numbers start to matter. Because if delivery requests grow faster than available registered silver, the exchange faces a challenge, not necessarily a collapse, but a logistical stress event. The exchange has tools to manage that stress, cash settlement options, incentives to roll contracts forward, temporary rule adjustments. These tools help maintain order, but they also reveal something important. They reveal how dependent the system is on participation behavior. If most traders cooperate, everything works smoothly. But if too many demand metal at once, pressure builds quickly. And pressure in financial systems tends to amplify. Prices can spike violently, liquidity can vanish, volatility expands beyond normal trading ranges, and headlines begin asking uncomfortable questions. Has the exchange run out of silver, or is the market simply experiencing delivery stress? Those two ideas sound similar, but they're not identical. Running out implies total failure. Delivery stress implies the system struggling under pressure. And historically, markets usually experience stress long before they experience failure. But stress itself can reshape price behavior dramatically. Because price is not just supply and demand. Price is also confidence. When confidence weakens, volatility replaces stability. That's why analysts watch COMEX vault data closely. Not because a shortage is guaranteed, but because changes in inventory reveal shifts in behavior. And behavior shifts can change the entire narrative. If investors believe physical silver is tightening, demand can accelerate. And acceleration feeds momentum. Momentum attracts new participants. New participants amplify volatility. Before long, the conversation changes from routine trading to systemic risk. And that's when markets become unpredictable. Now here's the real question investors should ask. Not whether COMEX will run out of silver tomorrow, but what happens if physical demand begins colliding with leveraged paper markets? Because that collision is where volatility is born. And volatility is where fortunes are made or lost, depending on preparation. In part 2, we'll examine the deeper mechanics, who actually hold silver in COMEX vaults, how delivery requests are processed, and what history shows when physical demand suddenly spikes. Because the day COMEX runs out of silver might not look like a dramatic headline. It might begin quietly with small numbers that most people ignore, but small numbers can move markets, especially when the system behind them is larger than most investors realize. Before we continue, I want to hear your perspective. Do you believe COMEX vault inventories are strong enough to support the silver market? Or do you think physical demand could eventually overwhelm the paper system? Comment strong if you trust the exchange structure. Comment pressure if you believe the system could face stress, because understanding how markets function is the difference between reacting to headlines and anticipating them. And anticipation is where smart investors live.